Let's talk about trade receivables. It's a term you'll hear sometimes in accounting class and also sometimes in the business world. So we're here to break that down today. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. So what exactly is a trade receivable? Well, a receivable is something that you're going to get. You're going to receive that. So it's money that somebody owes to you. Now, in this case, we specifically are talking about the customers of a business. So trade receivables come about because you sell to your customers on credit. You have not received that money yet. So we can separate out our trade receivables from our non-trade receivables, those amounts that are due to us but don't have anything to do with our customers. And an example of a non-trade receivable would be something like if you have to make a deposit with your utility company, for example. That money is owed back to you at some point, but it has nothing to do with your customers. This is something that you do as part of the business rather than as part of your relationship with your customer. So a trade receivable is all about the customer. So when we're talking about the value of a trade receivable in a business, when we grant credit to a customer, that comes along with a certain amount of risk that we will not get paid by that customer. So that's an important business decision to make. If you are a very small company, can you afford to grant credit to your customers? What's the process you're going to go through in order to vet that customer to make sure that they're going to pay you the money that's due to you? So it brings an inherent risk to a business. And part of the way that we handle that inherent risk of granting credit is to keep a very close eye on our receivables, our trade receivables. And for larger businesses, we want to make sure that they have what we call an allowance for doubtful accounts. So we're going to look at our accounts receivable balances, and we're going to say there's some portion of our accounts receivable that we will likely not get paid for. And so we set up an allowance account to keep track of that. And what we're doing with that allowance account is we are capturing some bad debt expense in the month of the sales as they happen, which relates back to the matching principle that says we want to put the expenses in the same month as the revenue. So whatever our revenue is, we're going to take some portion of that based on historical data and an estimate to say we know that there is a risk involved here, an expense involved in granting credit, and so we're going to keep track of that through our allowance for doubtful accounts. And there you have it, trade receivables explained. Until next time, stay balanced, my friends.